Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Bernstein, managing partner, FTV Capital, to discuss the evolving PE landscape to allow for capital at every stage. We're also going to discuss how AI could impact PE when it comes to valuation and investment strategies. Brad, it's great to have you with us. Welcome to TradeTalks.
Great to be here.
You're celebrating your 25th anniversary at FTV, and you've been with the firm for a vast majority of that time. How have things changed or evolved within your space, and what's exciting about the future?
Sure. Well, financial services and enterprise technology have been intermingling and expanding, creating a massive, massive pool of opportunities. Digitalization of business is perfect for the integration of financial services into it. And so our ecosystem for investing has really expanded dramatically and created huge opportunities. And of course, we've evolved, getting better and better at thinking about how to institutionalize how we help entrepreneurs build their businesses, consolidate, grow, and position themselves for liquidity events and opportunities in the future.
Well, let's talk about that. You've advised numbers of portfolio companies through turbulent market times, different times in the economic cycle. How have you been advising companies through this latest valuation reset?
Sure. Well, one of the things about FTV is we always use very little leverage, really try to capitalize the companies to focus on their organic growth. In fact, our average portfolio company grew 47% last year. So these are very dynamic, high growth businesses, and that growth offsets any multiple compression in a pretty meaningful way. And because we don't have much leverage, we really build the companies to weather any storms and position them for the long term. This year, though, given what was going on with interest rates, we really told all of our CEOs to prepare for challenging times, hunker down their cost structures, focus more on profitability, and really kind of move away from that growth at all costs mindset we saw during the pandemic to more disciplined investment in expansion.
Clearly, we list companies at Nasdaq. What are your thoughts around the role reversal we've seen with private and public markets that really, it's kind of been since the dot-com bubble, more recently now, as less companies have come public this year. What do you think that implies for future market behavior?
Yeah, it's fascinating because not only has the public market become less hospitable to companies given the regulatory environment, the cost of being public, but what we've also seen is that the ecosystem of private equity, the flavors, alternatives available for entrepreneurs to finance their business, and even for private equity firms and venture firms to achieve liquidity in the private market is getting better and deeper and broader. So that gives companies a much longer runway to stay private and run the business with an orientation that's really built around long-term value creation rather than making the next quarter. So that's a really important change. Now, I'm hopeful that the public markets will be more receptive in the future, but it has been over the last 20 years an interesting evolution that's really opened up the door to a bigger and bigger private equity and private credit market.
Well, clearly we can't have a conversation without discussing AI, right? What do you think the impact will be on the PE landscape, particularly when you think about investment strategies, valuation?
Sure. Well, look, we are at the peak of the AI cycle, although I guess it could get worse, but it's pretty intense right now. And I think you really have to think of AI much like PE. There's many flavors and different aspects of it. And what we're really doing at this moment is trying to understand how companies are going to use this technology. Many of the things that most people are excited about are free. You can go on and use Google Bard at no cost or ChatGPT. And so that's really a hard thing to monetize in a vacuum. You have to think about where in the enterprise or dealing with consumers you can apply these technologies for maximum effect. So our view right now is to focus on the services around AI, helping companies evaluate their opportunities, trying to figure out which companies are best at implementing it, what they're doing, how they're executing it, and then thinking where in our portfolio we can deploy AI to improve the productivity and value proposition to our customers. And we have some great companies that actually are AI-oriented, technology solutions for corporate clients and consumers, such as we have a company, Zuvu. They serve the guided shopping using AI to help consumers and business customers go through a sale process where the AI helps find them the product they're looking for, helps configure the product they're looking for. Solutions like that have such a high ROI for the customer. And that's what we're focused on.
Let's talk about the shift from growth at all costs to growth to profitability. Balance sheets matter, governance matters, especially with privately held companies. How should PE firms adjust their valuation techniques and investment strategies to account for this?
this is a really important question at this moment. We're going through a massive pivot. And what's fascinating is many of the people that work in PE, even many of the people who work for me, weren't working in the last financial crisis or when interest rates were much higher. So really revisiting that and thinking about what are the implications is critical. The first thing that happened, obviously, is the move away from revenue multiples and growth at all costs to cash flow, and it's refreshing to kind of focus again on EBITDA, cash flow generation, and think about valuation in that context. But I think the next shoe to drop is that as we start seeing that we're going to have higher interest rates for longer, and you think about the 10-year being higher than it was over the last decade, and you start thinking about a risk premium to that higher 10-year, you have to think about, well, what are exit multiples going to look like in that context? And so all of us have to be rethinking and recalibrating how we're thinking about exits 5 years out in that new paradigm, which is quite different than the market we were in for the last decade.
Did you think that valuation reset needed to occur? I mean, certainly through 2021, and then you saw the companies come public. They haven't touched their opening price since then, and the public investor is the one that gets in at those prices. I feel like this valuation reset needed to happen for that reason, but also even companies such as yours advising young management teams that this is how things are supposed to work.
In a way, it was a great sanity test of founders you wanted to back versus founders you didn't. We've always been believers in rational enthusiasm instead of irrational exuberance, and we're really focused on aligning with founders about what are realistic expectations for your business. And when we saw some of the deals that were getting done at 100 times revenue, we knew that was going to head for disaster. And frankly, it's bad for the management team, the employees, everyone's options are out of the money. The founders got a huge preference that they have to deal with. So we always stayed disciplined through the cycle and anticipated some level of reset. But I think it's going to be dramatic. And I think over the next 5 years, we're going to see a lot of fallout, both at the super high end of the momentum investing end, and then also some of these way over levered companies that were, taking on 10 times debt to EBITDA at very low interest rates, where resetting that is going to be challenging.
Are there certain sectors that you focus on at FTV?
Absolutely. So we're focused on everything related to financial services, payments, asset management, wealth management. Love to see deals like Adenza that validate the kind of businesses we're building. And then we also focus on enterprise technology and services that are relevant to financial services, but other industries too, that can really move forward sales, marketing, compliance, risk management, data and analytics. So we don't really participate on the consumer side, which obviously has a lot more volatility. We like to stay focused on corporate clients and how we can help them innovate and build their business. All
right, Brad, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.